definitely cannot happen at all. Like,
I don't think it will though, you know?
Nobody's gonna know. They're gonna know. How are they gonna know? They're gonna know.
Oh, what? I'm sorry. I just did something.
Cannot happen. You said what?
I just did something.
What was that?
I don't know.
Well, I did something too.
What did you do?
I took us live.
Oh,
What up, Jolyn?
how you doing?
I'm all right. Do I look older or?
You look exactly 1 day older.
Okay.
Not even two, just one. No, I'm just kidding.
Well, I'll
you
take
still
it.
Look young.
Hey, it don't crack.
It doesn't.
All right, so let's send a special shout out to cousin Reggie. Welcome back to the
Reggie, my brother. Welcome back.
It's been a minute. It's been a minute, and people were like, "Yo, is Reggie good?" Like, people really wanted to know what was going on with Reggie, and so Reggie is so glad to have you back. Brother, we missed you. So,
brother Reggie,
back up to the top. Let's go. And of course, we got Butter.
Butter causing a ruckus.
Leaving camera. No, go back up. Nope, we ain't doing that.
Like, look, I'm trying to get comfortable.
He's like, look, man, this blanket here, and he's like, he loves this blanket, except that there's just one little problem.
What?
He does not specifically like this blanket. He likes the one that just only has Snoopy and Woodstock on it.
Butter.
Bougie, and he likes the New England Patriots blanket. So if I bring it down, he will stay on this pillow, which is interesting. Very, very interesting. But how was your weekend?
Everything is such a blur. Oh, well, your girl was on the Peloton or whatever, doing way too much. The ischial tuberosity was on fire. Those are your sit bones. And I'm just waiting for my, what is it? The bursa to do its thing, which is when the things fill up with liquid or fluid or whatever to guard your sit bones. It acts as protection. It's not like a blister. I mean, it kind of is like a blister, but it's not a blister, and it will shrink when you don't use it. So once you build that up, then the bike isn't as painful, or you get a gel seat or padded bike short. So I had to get all that.
Okay. All right. That was a lot.
Hey, how was your weekend though? That's what we really should be asking birthday boy.
It was amazing. It was amazing. Shout out to my wife for putting together an amazing gathering, get-together party. Food was amazing. People were amazing. I got to also celebrate my birthday with my brother, which was pretty cool. Nice. My brother is such a hoot. So shout outs to you, Dante, if you're watching. Love you, bro. And on top of that, just good people, got to vibe and everything else. So it was fun.
What?
Well, we'll save that for another story. I'll save it for an episode.
No, first of all, I want to know what you got.
Okay, so,
Top gifts.
Oh, I mean, my top gifts were pretty much, my wife's throwing a party. And of course, definitely got a Tesla wall connector charger. That was huge. I already have one installed on one side, but now I'm like truly legit, like setting up my own little like electric charging station here at my house. So just in case if I have visitors, boom, or if I get a second one.
What an awesome and thoughtful gift. I mean, that is just amazing.
And I even got some LeBrons for my birthday as well. So shout out to Tuesday and his wife Marta for the wonderful gift. And shout out to you, Jolene, because hooking a brother up with a Tesla wall connector, hey, you know what the vibes are. So
you can thank, who can you thank for that? I think you can thank Square, you can thank Amazon, you can thank SMH. Well, not right now, but like a couple weeks ago, you can thank. Those are the top three.
Okay.
Oh wait, and XLY. Those are and XLK. You can just thank all the homies, all the stuff.
Oh, okay. So we just
all of them.
All right. Well, thank you. It's been a vibe. And shout outs to each and every single one of you for sending me just warm wishes of my birthday. I truly, truly am thankful. It was overwhelming, but in a good way, because normally it's like I'm not accustomed to all that. So pretty amazing. Excuse me. This water is going to get me today, but I'm going to try to hold it back. But I also want to send a special shout out today.
Okay.
I want to send a special shout out to my grandmother, because it's actually interesting, because my birthday is on July 18th and my grandmother's birthday is 2 days after, which is July 20th. So Carolyn St. Cyr, wherever you are, AKA Granny, AKA like that woman, happy birthday and love you, and hope that you enjoy today's episode. And I hope that I've made you proud. So, all right.
Wait, I just got a text. So apparently my nephew is watching right now and he keeps trying to throw a ball and play catch with you. And he's waving. So I just want to let you know that.
All right.
Ethan is here.
I caught it. All right. So, okay. So shout outs to each and every single one of you, the cousins. And if you want to be a cousin, then go ahead and hit the subscribe button down below, so that way you can be a part of the content, because it's a ton of great content for you to sit back, learn, be educated, as well as be entertained. Because, what's education without a little bit of entertainment and creativity? And that's what we're all about here at the Come Up series, all for the free 99. And on top of that, if you like the video, go ahead and hit the like button. And if you want to be in the know or be like Reggie today in today's video, go ahead and hit the bell, so that way you can be a part of the notification squad, aka the Cool Kids Club. I feel like, like people think that I'm reading a teleprompter. I am not. But,
Oh, I am. Psych.
Right, so we got a little bit to get into today, but you know what? We got to first turn it over to like Jolynn. It's been quite the roller coaster, lately. Whenever I see volatility, I think roller coaster. So how do we do today?
Well, let's get into it. What does it, a cousin's Jolynn seem the place to be? And today is Trade Talk Tuesday. Let's go over what happened in this here market. We got the Dow coming in at 549.95 points. That's a lot of points. That's a lot of points. And the S&P 500 was up 64.57 points. The NASDAQ was coming in at 223.89 points. So we had green all across the board. We got the VIX coming in at 19.73. The 10-year Treasury note, yes, I looked it up this time, 1.22%. So, it's getting low. It's getting low. And then let's head on over to sector performance. So as you know, there are 11 sectors. We track the top 3 and the bottom 3 so we can see what that rotation is looking like. We got industrials, financials, and real estate coming in at the top 3, bottom 3, communication services, utilities, and the only one in the red today was, can you guess it? Consumer staples. Now, for pick performance, you can find all of the Come Up Series picks at that Come Up Series on our Instagram page. And we got Square coming in at number 1, followed by Boeing, then DocuSign. Then for the bottom 3, we have Netflix, which had earnings today, but they finished negative, which I feel like that just be happening. We'll talk more about that. NVIDIA, shout out to the NVIDIA split. I heard some of y'all had some heart attacks, some heart palpitations, but remember, today was the day that it was splitting. So,
AKA don't trust Yahoo, but
yeah. And CRISPR is coming in at the bottom. So, Mark, we had earnings. We had
do you have any 52-week highs today?
Oh my gosh. Did we? Are you just saying that because you want me to shout out something in particular? Let me see. Well, Square wasn't doing a 52-week high. Let me just scroll down and see if
I guess we got to send a special
FTNT 52-week high. Yo, I think you need to say a little something about FTNT because they were doing it. Shout out to ARK. Okay, first, never mind. I'm not even gonna go that route because seriously, ARK has been, there was a whole bunch of outflows. Now it looks like the inflows are coming because ARK was on sale.
Yes, it was.
We got marching its way back up. That was the only 52-week high it's looking like.
Question: do we have DocuSign on the pick list?
Oh, sorry, another 52-week high. Yes.
Oh. No, seriously, legit. I was just asking.
Yeah. That was they finished in the top 3 today. It was Square, Boeing, and DocuSign. But Boeing did not hit nobody's 52-week high.
At all. At all. All right. So we ready? Are we ready?
Yes, we are. Wait, let me make sure. Are we ready?
I'm gonna take a sip.
What do you want to talk about first? Do you want to talk about earnings? Do you want to talk about no earnings?
I quit school because of recess, so let me know how, let's do it.
All right, so this show today, y'all, is called Stock Market Essentials, right? Was that the title?
Mm-hmm.
All right, so I think this is one of those episodes that you're gonna want to get your pen and paper ready for, which I mean pretty much is every episode. But this is going to be a little bit of the, refresher for those of y'all who are OG Cuzzos, but then also just a good video or reference. So I definitely think timestamps, wherever Father Time is right now, should be a part of this show. Mark.
Okay. Well, let's first start off with a company by the name of Netflix, because Netflix is actually happens to be on the pick list. So let's quickly get into it. So for those that were wanting to know, essentially Netflix pretty much, it was very cut and dry, pretty much 19% year over year. Of course, we can get into the revenue part, which is pretty much 7.3 billion. But I think the biggest, and that was the part where they missed. So Netflix had beat on the top line, which was known as the earnings per share. And one day I'm actually going to just put it out there. I may actually just put it on my Twitter so that way you guys can actually see how the formula works for earnings per share. But it's pretty much blank over shares outstanding. Just want to put that out there for a hint. If you can figure it out before the end of today's show, kudos to you. So they beat on the top line for the earnings per share. They blew it out of the water. But then where they came in a little bit light was on the revenue side. But they made up for it when it came time for the one thing that everybody pays attention to, which is, do you know what it is, Jolene? Do you know?
I would say guidance.
Actually, this comes before guidance. There it is. Netflix is always judged based upon its memberships, or AKA its subscriber count. So they had a 1 million guidance forecast, which a lot of folks are like, well, wait a minute, Mark, that's not that heavy, especially when we see out here, Disney out here and all these other services getting significantly large amounts of customers every month. But au contraire, it's actually very tough once you reach a certain pivotal point, especially when you start reaching the law of large numbers. When you're in the hundreds of millions of subscribers, you're pretty much competing against those same type of eyeballs versus the folks that are watching cable TV, other streaming services, and whatnot. So there's that. And on top of that, we're talking about new subscribers that are coming into the platform. Now, one of the things that Netflix gets significantly knocked on for is because it's just one small thing. They bring in customers that are paying on a subscription basis, though I wish they would actually do it on an annual versus monthly. But you know what? Hey, I don't work there. But if, you happen to be listening, specific company X, then go ahead and start that annual subscription base, because I think that a lot of folks would truly, truly bless you for that, so that way they can be over and done with that. But the biggest thing is that they're knocked on for the fact that it's the revenue. Sometimes the revenue tends to miss because of the fact that they're the type of company where they either license out content, so which means that, or they're buying licensed content or renting it, or essentially they're having to pay to either acquire content, or also they're also paying to create the content themselves. So it's kind of like a double-edged sword though on the paying for the content or paying to create it, because of the fact that you can send it out to other places. So for example, if somebody buys the movie through Apple TV, then that's a financial kickback to, say, for example, Netflix, and so on and so on and so on. But at the same token, they think about it, when they were renting out when they were leasing Friends, the TV show series, which was a hit on their platform, or The Office, they were having to pay NBC for that licensed time, which that was coming out of their pocket, which were ultimately eating into their profit margins. Now, of course, where Netflix has gotten smarter is the fact that they started creating more original content. But at the same token, they're forever judged by their subscriber growth on a quarter-over-quarter basis. So essentially, again, sometimes you may see them reach 1.5. I'm probably sure that when we get towards the colder parts of the year, you're probably going to see subscriber growth climb around Q3, Q4, because of course people are coming in, so they're not out as much. No more vacations, people are inside. So essentially they're watching Netflix, or there's new shows that are also enticing them to come over to it. So that's one of the big things. And they're also working on this process of trying to get folks that are sharing their Netflix accounts across multiple people, where they're trying to get them to actually start paying for their own services, which, I mean, of course, when you do that, then essentially it provides an opportunity for you to increase your subscriber growth. So those are some of the things in which that they talk about. They also talk about like the forecast getting a little bit better. So for example, we forecast paid net additions of about 3.5 million versus 2.2 in the prior year period. If we achieve our forecast, we will have more than 54 million paid net ads over the past 24 months, aka 2 years. So, or 27 million on a annualized basis over that time period. So that's actually not bad. That's about roughly, what is that? I think that's about 5% growth year over year. So that's pretty good. So I guess the biggest thing that also kind of like led the stock higher was that they confirmed Wall Street's assumptions about them getting into the gaming sphere and answering some of those questions, especially over the call. Though that essentially it's still a little bit too soon, too new for us to really see exactly how this is going to shape out. But you're welcome for that nugget. I guess I'm not going to give any more of those. But outside of that, congratulations, Netflix. You had a great quarter. Nice. That's the breakdown. I guess the biggest part also is that I think that they're also getting better when it comes to their profit margins also. Mm-hmm. Though that their profit margins are getting better, but they got to figure out exactly how to start decreasing their operating margin, which means that, again, when you pay for content, it eats into the actual margin. So if they start lowering that down, then you're going to start seeing Netflix talk. We're going to start having different types of conversations about Netflix. But word on the street is that there may be some extra coverage being picked up, and Netflix may be graduating up to the level of like the NBCs of the world and everything else, and ultimately Roku taking its place, and then somebody else taking its place. Shout outs to Q, aka Mr. Wall Street. Shout outs to Big Cousin Q. So for that little nugget. So
I'm mad at Netflix just a little bit, because I don't see why they are trying to shake up my 70-30 life by cracking down on people trying to get them to get their own subscriptions. Because let me tell you, the way this 70-30 is set up, okay, like I'll be like on my mom's account all the time. It's a family account.
Yeah, I mean, but at the same token, you have to think about it like this. It's like, especially for one user, I mean, I guess it works up to a certain amount of people, but then when you got like 11 people using the same account,
you can't do all that, because then it's not like, then when you're watching something and then someone comes in, like they might boot you off and then you can't watch it.
Right. So that's one of the ways in which that they're actually starting to crack down on users from actually like using that. They're taking the same model that YouTube TV does, where it's like, okay, hey, X amount of folks are watching, so then you can't be watching. So you have to boot somebody else off, which doesn't make any sense, because you can share it up to 6 people, but all 6 people can't watch it from different sources. But, God bless. They'll figure it out. So I mean, honestly, I get it, especially when we talk about data costs and pinging different servers. So that could be also potentially an issue, because when you have the meter running on such data services, it can get pretty expensive. So, and for anybody that's in startup world or that works in tech and that has ever used, like, say, for example, Amazon's AWS platform, that junk is expensive. So you get what you pay for. It's good, but at the same token, it's an expensive service.
I got some coin there. So good job, Netflix. Good job. So it looks like people kind of like piled in anticipation of earnings, and then, sold at whatever high it was, and then
it's up. So now it's up, but I think it's up a little bit, up more than 0.5% right now in the aftermarket. So yeah.
So good job, Netflix. Good job. So you heard about Chipotle. It's not one of our picks.
It's not one of our picks yet.
But I really like, besides, shout out to Q, because he stays down to the...
Stays with Chipotle.
But
Yeah, definitely shout out to them. I mean, especially since we're rebounding. I mean, of course, it's like they did very, very well during the pandemic. And of course, it's like, it's become quite the cornerstone amongst it's a generational restaurant, just like McDonald's was for baby boomers. You have Chipotle for the millennial generation. And I don't know what it is for Gen Z, but I'm probably guessing that Chipotle probably plays a part in that. And then on top of that, how they've been able to streamline their process as it pertains to getting, food from, say, for example, supplier to the restaurant. It's amazing. So, and then on top of that, you're 9 times out of 10 when you're eating Chipotle food, you're dealing with like local grown food. So, notice I was saying this earlier to someone. I said, notice like if you go to like Seattle versus buying Chipotle in Atlanta, the food is probably going to taste maybe different. So
I don't have any plans to go to Atlanta anytime soon, but if I see a Chipotle on this vacation, I might.
You're gonna test it out. You're gonna test that theory.
Yeah, because up here, everything's organic up here. So what I be choosing is organic. So I'm like used to that. But like a place that's kind of landlocked like that, is probably not as good.
Yeah, I mean they're doing very well with the ghost kitchens as well as their Chipotle lanes. I mean it's a very streamlined process for anybody that doesn't know. I mean, one of the reasons why you see a lot of restaurants going into, say, for example, delivery or pickup services is because you're talking about turnover rate. The higher the turnover rate when it comes to food or any type of service within that arena, like, food, leisure, and all that other stuff, the higher the turnover, the more money that they make. So then it becomes more profitable. The less of the slower the turnover, the more money that it's costing them. So, I mean, just keep that in perspective for restaurants that are trying to make their process faster without giving up quality of food. That's the reason why you see that they're going to do significantly well. So just something to.
I might have to get Chipotle for dinner tonight. The way you talking, every time we're on the show, like I'm always thinking about dinner. Dinner plans be like.
Well, let's move on. Let's shift it a little bit.
I'm hungry.
let us shift it because, well, before we even start, I want to talk about something that's like been asked of me about like quantitative easing. So I was doing a little bit of searching, and so folks were like, well, how does quantitative easing work? Because of the fact that we hear all these things about the 10-year treasury yield and everything else, and people getting spooked about bonds and everything else. And what does all that mean? Well, there's a beautiful diagram that has been produced. I did not produce it, Wall Street Journal, along with some other folks that helped them do it. I'm going to use their material. So since they like to use our material, why don't we just share the love? All right. So how does quantitative easing work? It comes in pretty much 3 steps. I mean, there's more than this, but they keep it simple. Now, notice it's like if you see here, you see the lines going from the Fed to bank security dealers and then investors, and then it works its way back. Now, the Federal Reserve in step 1 buys mortgage securities and treasuries. So mortgage securities, meaning AKA mortgage debt. So a lot of banks that may hold on to it. That's essentially in which what the Federal Reserve is buying, along with treasuries from banks and security dealers, AKA companies. So think about it, like the reason why you saw the market got spooked a little bit when they heard this word tapering is because of the fact that the Fed has been buying a lot of stuff when it comes to, say, for example, companies that were in trouble or companies that were pretty much vulnerable during the pandemic. And so essentially they buy that through the trading arm of the New York Fed. So essentially they buy up X amount of the treasuries, whether it's corporate bonds and from banks or from, individual businesses, and then they hold that. Then this removes these safer investments from the market and pushes down yields on these investments. So essentially when the Fed does that, hence the reason why when you saw the Fed start bringing in quantitative easing, you also started to see bonds ultimately start to dip like significantly, almost down to pretty much practice. Yep.
We have a request for you to slow down.
Oh, I'm sorry. I'm sorry. Where should I start? All right. So let's start over from step 1. So when you have the Federal Reserve, they're buying mortgage securities, AKA mortgage debt. So now that they bought mortgage debt, so that's like, for example, like companies or banks that have been holding on to X amount of assets, so that way they can keep their books clean, so that way they can keep their lending markets and pretty much credit markets still running. And then on top of that, you have treasuries or say, for example, other securities, AKA corporate bonds. So there's two types of bonds. There's treasury bonds, which are backed by the United States government, and they're pretty much a guarantee that says, hey, we will pay you back at a certain percentage return. And then on top of that, we also have corporate bonds, which aren't backed by the United States government, but what they do is essentially where you can buy into, say, for example, companies like, for example, if you look at Tesla, they also had corporate bonds. If you go back before they even went to the S&P 500, I think they had like two different corporate bonds that they had issued out, which people were buying up. And what happens is that when they sell those, it gives people X amount of, say, for example, large amounts of stock. So essentially they can exercise that right to say, hey, we're going to turn this into stock and have a significant amount of ownership, or they can just sell it and essentially get their money back at a specific return. So then we have step two, where they say that this removes these safer investments from the markets and pushes down yields on these investments. So a yield is considered the profit. So it's like the yield, think of yield as profit. So then you have folks that are buying bonds, and then there is there's a treasury bond. And then there's also, so that's interest rates, and then there's treasury yields. The yield is essentially, it shows you the type of return in which that you can get from, say, for example, a 20, 30 year, 10 year, whatever it may be. It goes from 1 month to 30 years. And then on top of that, it's like the higher the yield, the higher the potential return. The lower the yield, the lower the potential for the return. Now, of course, the rates are the rates, and that's ultimately how banks ultimately make their money. I think I said this a few episodes, where essentially banks, what makes them significantly profitable is not the types of service packages that they sell or the products that they sell to customers like you and I, like, for example, giving folks mortgage loans, auto loans, credit cards, personal loans, and whatnot. It's more so in the sense that the interest rates that are tied to them, and then that's ultimately how they collect their profits. Now, of course, when you're carrying a lot of that and you realize that, hey, that your consumers are probably going to be facing some issues when it comes to paying those things back, that's when the Fed steps in and says, hey, we will buy that. And so essentially, here comes the third step. Investors turn to other assets like stocks, corporate bonds, and even commodities, pushing their prices higher. So essentially, when you see interest rate yields down, then that means that essentially it becomes more of a risk on. And that's where you start to look at where other things they start to begin to look more attractive. So when we look at 2020, why did we see stocks literally going for a significant run? When we're just talking about stocks, the reason why we saw stocks go for significant runs was because of the fact that there was not very much else to really put your money to actually receive a return. So for example, if your yield was at, say, for example, 0.25, but yet you know that such company grows at a 15 to 20% return year over year, then you're going to turn to that company's stock and ultimately buy that because you can get a better return. Now, of course, I can get into the option side of the market, which was the real reason why you saw option prices really significantly boom, was because of the fact, and we're talking about like astronomical, was because of the fact that the volatility index significantly spiked from like 10 or 12 to like 90 in the VIX. And then that created a significantly high implied volatility in an options market, though that stocks are going a specific way to the upside, but yet the implied volatility is high. That also makes the rate of return even higher. So hence the reason why folks were getting significant payouts. Now, when that volatility starts to come down, that brings down the implied volatility as well. It's not to say that it's still not lucrative, but it's just more so in the sense that you have to be a little bit more careful, a little bit more strategic, hence the reason why I tell people to focus on the long term. Now, the reason why we see that we see this arrow go backwards, because all this goes around in the cycle. And the reason why you do this is because of the fact that you take the risk off of the table to stimulate the economy, which spurs your consumers to want to spend more at these different places or different venues without, say, for example, any potential hiccups. And then essentially when you start realizing that the economy is starting to get stronger, you start to remove this stuff off of your balance sheet. So that's where we're at right now when we're talking about the Fed literally removing stuff off of its balance sheet. So now it's like people are like, okay, well, when does it start? My projection is that the announcement will come around November, December, and then the actual tapering will start to begin January, February, where they start to remove a lot of these assets off of their books. And then ultimately the economy is recovered. or the economy showing strong signs of recovery, and at a point in which that we have some stability, the Fed can start to clear its balance sheet. The reason why the Fed clears its balance sheet is because of the fact that if you have a terrible balance sheet that's locked up and then another recession hits, there's no way that you can literally prop up the market now. So essentially now both of your hands are tied behind your back and the economy can literally crash. And what I mean by crash, we're talking about like 1920s, like Great Depression type crash. And nobody wants to see that. So essentially you do that so that way you can remove some of the tension off of your books and then essentially make room for the things that will come later on down the pathway if they still come. So the goal, lowered rates on bonds will keep mortgages and other consumer rates low and encourage investors to buy assets with higher returns and more risk, such as stocks and corporate bonds. Now, what are the risks? Critics argue Fed money printing could cause a dollar collapse and spur inflation later. Does this seem familiar? And doubt it will feed through the broader economy. Interesting, because it has fed through to the broader economy. Now, of course, the thing is here, what we're looking at is now we're seeing that the yields are coming down, but at the same token, what we're looking at is the dollar. So now we look at the dollar and say, is the dollar too strong? Or is the dollar getting weaker? Now, there's a certain balance when it comes to the dollar. The reason why we say that there's a certain balance when it comes to the dollar is because of the fact that now it's a matter of not only just people here in the United States and what they're buying, but it's also in the sense of folks around the world, the global economy, stepping in to buy things like a la US-based stocks and everything else. So notice when you see a strong dollar versus other currencies, you'll see that essentially that the buying or selling can kind of subside a little bit because of the fact that, hey, the dollar is too expensive. So essentially it's like, we're not going to pay at such a high price premium. But when the dollar starts to subside, then now you start to see other countries come in and say, hey, risk on, because now we can buy it. It's cheap.
So what can we, given all that, what can we expect like going forward?
So what we can expect going forward is here's where we currently are. We have a lot of short-term inflation. So a way that you can look at that is, if you want to see exactly where the economy is, go on, you can use CNBC if you like to, or any place where it shows you bonds from 1 month to 30 years. And then look and see where the discrepancies lie between, say, for example, they should be like the highest bond yield should be at the 30-year, and then the lowest should be at the 1 month. If at any point in time where you see that, say, for example, the lower bond yields are higher than any of the longer term yields, then that can show you that there is a potential problem. And we were seeing that between the 1 month and 6 month and 3 month and 6 month. And now I think it's kind of subsided and come down to the 1 month and 3 month. So that could be something where it's telling you, all right, well, hey, there's some short-term inflation here. So with short-term inflation, that hits consumers as it pertains to what they pay for at stores, as well as, for example, the cost of goods and everything else. But then at the same token, a weaker dollar means that essentially when it comes to paying back things, or say, for example, borrowing things, if you're borrowing things at a weaker dollar, then that's an advantage. If you're borrowing or with a stronger dollar, and when it comes to paying it back. But if you're borrowing on a weaker dollar, and especially when we're talking about paying back treasuries, then the rate of what you have to pay back is way higher because of the fact that you have to make up for, say, for example, the loss of its value. That's just giving some folks a little bit of like an early Forex thing that, though I don't teach Forex, don't ask me, don't do any of that. I strictly stay in stocks, options, and nothing less, or nothing more, unless it's a little bit of crypto here and there. But hopefully you guys picked up that gem. So let's move on to the other part of that, because people are like, well, how do we see that play out in the market, right?
Are we gonna look at a chart, Mark?
We're gonna look at a chart, though that it may be a little fuzzy because it's a little old. But at the same token, old things are good things. Remember that.
Hilarious.
All right. So as you can see, we saw quantitative easing plus 42%. This was back in the financial crisis. So this went from December of 2008 to March 2010. So you saw a lot of quantitative easing, especially it takes place around the time that you see that the market tends to just definitely go down. And essentially from here, we saw essentially that this is the red line represents the S&P 500 and the blue represents the quantitative easing period. So then, of course, we got a peak, and then essentially we kind of like just kind of scaled back and, just kind of corrected here. And then essentially we had another quantitative easing period because of the fact that we were dealing with unemployment and that being a significant issue because we were still trying to figure out exactly what were the impacts of, say, for example, the financial crisis. We were still feeling those effects. So that's something to pay attention to. So essentially here we are. And mind you, this goes from 2008 to 2013, so keep that in mind. But I mean, you can look for patterns, and I'm trying to tell you, history has a history of repeating it. Whatever. All right, so quantitative easing 2 plus 24% from November 10th to June 2011. So here we are. We see, say, for example, some quantitative easing at the end. Now, of course, when the quantitative easing period ends, we come down. So, of course, down 14%, end of quantitative easing, true. All right, so then we had Operation Twist, plus 20%, September 2011, and all the way up to June 2012. Of course, we went up. And, of course, when the quantitative easing had ended, we dropped. And then, of course, here we are in, pretty much quantitative easing the third, up 16%. But then at the same token, negative 6% peak through. So that's something to keep in mind when you look at the S&P 500, because when you start looking at these moments in which that you see, say, for example, after quantitative easing periods have ended, you tend to see that the stock market tends to go more so towards a bearish time period, in which that, okay, hey, maybe for a few months or maybe for a quarter, you'll tend to see that the market tends to price in, say, for example, the tapering process. And then essentially it pretty much goes back to regular scheduled programming.
So right now, like a couple weeks ago, it was, or not even just a couple weeks, like last week, things were down. But you had Brother Jerome talking, trying to reassure folks, but there was panic. There's all this stuff going on. Now the market, and that spilled over to the beginning of this week, and now the market looks like it's rebounding. Mm-hmm. But it's like, for how long? Right.
So what you're seeing right now, what you witnessed as it pertains to the last week, I mean, that was a significant period that a lot of folks didn't really pay attention to. That was a major month contract for the month of July. So July 16th. So that contract's coming to an end. Mm-hmm. And if you notice, there was a heavy duty amount of volume that was literally leaving the market or that was trying to maneuver through the market. And so essentially it triggered a lot of folks that were pretty much selling off to get out of contracts or whatever it was. It wasn't a witching period or anything like that. So I want to make sure it wasn't no triple witching or something like that. It was just literally just a moment in which that you saw a major contract coming to its end, which created a lot of volatility. And also when you see a lot of volatility, it can spur a sell. And kind of like spook people to think that, okay, hey, the worst is yet to come. And given that we're in a 24-hour news cycle, they've got to sell advertisement tickets. So essentially it's like, that's all that they're going to talk about and throw up the wonderful bear market sell-off graphics that are so dated, but whatever. So I think the biggest thing is that we were due for a pullback because a lot of things were getting a little bit significantly stretched, and pullbacks are pretty healthy when it comes to the market because of the fact that it gives us just a little bit of shock of reality. And then ultimately says, all right, well, to let you know that the stock market is not always made to just always go up. People do take profit. They want to sell in order to get into something else. They must rotate. So you're going to see those things happen. I think the major correction that everybody's thinking about, which is quote unquote on schedule, you'll probably see that start to happen around late August, going into mid-September, and then playing out all the way through pretty much October. And then after that, it's like back to regular scheduled programming as usual.
Okay. Okay, so that's good. So given what we just went over today, what else, as far as just kind of getting a handle on what's going on, what else can come up cousins look for?
I mean, honestly, there's really nothing else to look forward to from the Fed because they've already said what they're going to do. So there's nothing else there. It's like pretty much just get ready for hearing pretty much a rerun. It's like watching a rerun of like Living Single or something like that. You know what to expect. I would say, honestly, the things to really watch is really earnings. That's the period in which that we're in now. And it's like, it's a great thing that we had a pullback right before earnings, because now it's really time to see who's who. Now that you go into the second part of the year and really going into preparing for next year, which there's a lot of optimism for next year, as well as 2023, you're going to probably see a lot of folks wanting to get positioned over the course period of these last few months of the year. And ultimately, the other part that you're going to see is that the fact that you're going to be looking to see, hey, is the economic data getting any better? So where are we? Like, whose argument wins out? Is the bond market telling us that, all right, hey, the Fed is correct when it comes to short-term inflation, and there's nothing left to see here. Wait till essentially it's time for us to raise rates and start tapering, and then do your bidding? Or is the market starting to price that in? The other part is, could the Fed be completely wrong? And essentially they're going through all this process and we're getting ready to see a little bit more quantitative easing that's going to come through in the form of, say, for example, stimulus from the United States Congress, and some of those infrastructure pieces, which ultimately turns risk on for investors again. And again, the biggest part that the biggest part that companies are struggling with right now is, I think the thing looking forward when it comes to like a lot of the companies out there that are significantly hiring, that they're struggling to hire folks. Mm-hmm. Like a lot of these companies are competing against the United States government. Think about it. If you're collecting a unemployment or some type of stimulus that's better than what you would have stood to get paid by, then why would you go back to work for another company? Why would you go back and work for that company that's going to underpay you? So essentially now that's kind of like the dance in which that, we're dealing with on not only the legislative side, but also on the Fed side, and as well as the Treasury. So that's something to definitely pay attention to as we go into the second half of the year. And really that $3.5 trillion spending budget or plan or whatever you want to call it, that's going to significantly matter, because if you turn that on and if that passes, then that ultimately says, okay, hey, we go back to risk on for the time being for the rest of the year. So honestly, at that point in time, will inflation really matter? No. Will, say, for example, employment numbers really matter? Probably not. So essentially, there's a lot at play there when it comes to that spending budget. So I would definitely be watching that. And from my guess, I think that we're going to find out tomorrow for sure.
Anything about like COVID, and actually I don't even like to say that word, but
pandemic. Mm-hmm. Yeah, so things to watch, and we've been hearing rumors about like Tokyo Olympics may be scaled back, or for example, certain things may not be happening at the Tokyo Olympics, which could possibly play an issue. Mm-hmm. Because again, a lot of companies have already been hit hard because they were expecting revenue. So it's going to be very interesting to see who those. I would say if you get the chance, go look up the Tokyo Olympic sponsors. So see who are all those corporate sponsors, and then get a feel for like, okay, hey, if you're a sponsor, do they need people to actually physically be there in order for their business to essentially generate significant revenue, or do they not? The companies that need people to be there physically to generate specific revenue, you definitely want to look at those with a side eye and say, there's some potential risks there. But the companies that don't need people to physically be there, so we're talking about like more like your digital or software or those types of companies, tech companies, we already know that they're exempt. So now looking at other things, like for example, if you're a food company, or say for example, if you're like a McDonald's, well, that could possibly cause some issues, especially if you're not going to have that type of revenue that's coming through. Another thing that can cause an issue there is the fact that if the Olympics itself is canceled, and a lot of folks are probably saying, okay, hey, well, do I get my money back when it comes to, paying a lot of these corporate sponsors, or is this something that they're just going to have to take on the chin and say, all right, well, hey, it's done. So that's something that a lot of investors are really like trying to wrap their heads around to figure out, okay, hey, well, where is the risk here? Where are we vulnerable?
So in our last 14 minutes here or so, were there some terms you wanted to go over?
I did. So I pulled up this wonderful infographic and it gives you some stock market terms that like people should know, but essentially it's like, hey, it's okay if you don't, because we're going to go through some of them. So we're going to go through some of the basics. So buy, I think everybody knows what that means. It means to take a position or to buy shares in a company. Sell, to get rid of shares that you purchased, either because you achieved your goal or because you want to cut your losses. Bid is what you are willing to pay for a stock, or even in the options market, it still works the same way. Ask. Ask is, on the other hand, is what people are selling stocks and looking to get for their shares, or say, for example, it's pretty much the price in which that you will pay. So then we get into these things called, like, for example, bid ask spreads. Now this gets more so into the options arena, where the bid ask spread is the difference between what people have to spend and what people want to get. The spread must be resolved before the transaction can take place. So we're going to get into that a little bit later on in the year, or not even later in the year, probably like sometime next week, where I talk about bid ask spreads, or just spreads. Bull markets, pretty much bull market is a market condition that means stock prices are expected to rise. Bear market, the complete opposite, where stocks are pretty much selling off. Limit orders, and a lot of folks need to understand this because, of course, a lot of folks get caught up into paying at market price, which means that you're paying a lot higher. And when you're selling at market, sometimes you're not selling at the high, you're actually selling at the lowest price. So essentially, when you set a limit order, that means that essentially that you set the price terms of what is it that you're willing to spend. And essentially, it's like a limit order provides instruction to only execute at that price or above sale price. Always use limit orders, not market orders. That's always a good thing. But it's funny because they say that, and then at the same token, brokerages always keep that there. So something to think about. Market orders, pretty much. Now here's the thing about limit orders. The thing about doing limit orders is that the fact that it could take time, and also you could possibly miss out on the position, especially depending on how volatile, how much the stock is moving. A market order, you're just wanting to execute. So which means you don't really care about the price at this point in time. You're just wanting to get in and get the action. A market order provides instruction to execute as quickly as possible. Pretty much that's it. Good till canceled order. So pretty much you set your price, and essentially it means that your order stands until you cancel it, and it will be executed whenever the stock becomes available at that price. Day order means just pretty much good for the day. Volatility. Volatility is simply how fast the stock moves up and down. So essentially, when that stock moves up and down, it creates volatility, and ultimately it can have significant impacts. So liquidity, pretty much cash on hand. So how easily you can get into and out of the stock. Trading volume is the number of shares being traded each day, a factor that is huge, that has huge implications for stock's liquidity. So let's just do a quick little breakdown about like trading volume. A lot of folks are like, well, Mark, how is it possible that a stock traded, say, for example, 17 million shares, whereas everybody's selling 17 million shares? No, they were not selling 17 million shares of the stock. It just means that at a specific time, maybe the buying may have subsided and it was more volume of folks that were willing to sell at that time, which can actually impact the stock. So for example, let's say that out of those 17 million shares, a lot of times people were buying at that time, buying and selling throughout the day, but yet there were more buyers. So that means that there was more so towards the upside. But then on the flip side, if there's more sellers and yet there's less buyers, then that ultimately, then that trading volume can send the stock going lower. All right. Going long, you're betting that the company stock will increase in price so that you can buy low and sell high. Averaging down. So this is a term in which that we hear a lot, or dollar cost averaging. This is when an investor buys more of a stock or an option. As the price goes down, this results in decrease of the average price at which the investor purchased the stock. I'm going to keep going a little bit further. So capitalization, market capitalization refers to what the market thinks a company's value is, aka valuation. So when we think about it in the startup world, it's all about valuation. When we think about it, when you go to a publicly traded market, now it's just market cap. They're pretty much the same thing, but there has to be some type of thing that drives it together. And a lot of times we look at it as it pertains to its book value, AKA stuff like revenue, expenses, and all those things that come together to create a market cap. When we look at public float, this is the number of shares that can actually trade once shares that insiders like the company C-suite and early investors control are subtracted. So pretty much like when you see, like, for example, all those folks who own the shares, but then when you go public, it creates a significant amount of shares. And those are what we call shares outstanding. So when you see shares outstanding, that's pretty much known as the public float. Authorized shares, the total number of shares that a company can trade, it's always bigger than the public float. So there you have it. IPO is an initial price offering, which happens when a private company becomes a publicly traded company in order to raise money. So here's the thing. A lot of folks think that essentially that you stop raising money when you become a publicly traded company. No, the reason why you come to the publicly traded market is so that way essentially you can borrow against your market cap. So essentially you can raise money against your market cap versus having to go to pitch to investors and tell them how star-spangled awesome you are. They can look at the market cap and literally just use that as it pertains to your credit for the company. Secondary offering, if a company stock is doing well, they may do another offering in order to sell more stock and raise more cash. So that way they can build up more liquidity, maybe make investments, whatever you may have. Blue chip stocks, these are large industry leading companies offering stable dividend payments. So for example, the reason why people like Coca-Cola, why they like AT&T is because those are considered blue chip stocks. Forex, foreign exchange, involves trading different currencies. Hedge funds, mutual funds, pretty much two different types of investment accounts that you can buy into. They turn around and invest your money in dozens, hundreds, or even thousands of stocks all at one time. ETFs, exchange traded fund. Pretty much, if you ever saw the episode where I did the breakdown of the ARC funds, think about it like, for example, if you cook, you don't just like throw the meat into the oven or onto the stove. You add some seasonings and everything else. So everything that you add together, it ultimately makes, say, for example, that ETF, all those companies that come in together as one package, one meal that you're going to make. I think I'm going to start moving through some of through some of these things. Let's get to the next line. Day trading, practice of buying and selling stocks in the same day. Dividends, pretty much it's like when the company's profitable, they give you a portion of those profits, aka the earnings, and they give it to you pretty much in a small little kickback. An exchange is a place in which that different investments are traded. Execution, when you order to buy or sell, when your order to buy or sell has been completed, if you put in an order to sell 100 shares, this means that all 100 shares have been sold. So it's been executed. Margin, pretty much like credit. It's like you take out a loan to ultimately trade, and ultimately you do that with the brokerage. Moving average, a stock's average price per share during a specific period of time. The two things that you really need to care about, it's correct, 50-day and 200-day moving average. When the 50-day crosses the 200-day moving average in a downward sign, that's called a death cross. When it crosses going to the upside, then that means that it's a golden cross, which means that it's bullish. Death cross meaning bearish. And I think I can probably stop here because pretty much we're at the end, and I think that everybody kind of understands this. But to go to the final piece, which where we started, aka yield. This refers to the measure of the return on an investment that is received from the payment of a dividend. So there you have it. And those are some of your stock market essentials. I hope that each and every single one of you were able to follow along and check it out. But yeah.
That was awesome. And I also think I was putting this in the chat, but these are things, especially if this was review for you, which it was probably review for the majority of you all. But so what if it's review for you? It might not be review for your kids or someone else, a friend, a family member who's coming into the market. So with, learning new things, even if you already know it, it's cool to just be, humble and teach somebody else. This is not just for you just to know, teach somebody else. And you can make flashcards, quiz each other. It's perfect for kids to start learning.
And I just dropped the link in the chat so that way people can have access to it, but I'll also add the link in the video description down below, so that way you could check it out and, you know, learn some of the tools, and, you know, maybe even put some of these things into practice. So there you have it.
Yeah, I think that's great. So we have Thursday coming up.
Yep.
Hot take. So you already know, get your questions in. I'll send out the story for that. And then, I mean, it's like the countdown to vacation for me. I don't know about you, Mark, but,
Definitely countdown to vacation.
so next week is our final week before we go on vacation. So we will be here on the 27th and the 29th. And then we'll be on vacation for 2 glorious weeks. So y'all have at it, hold it down, breathe, do whatever you got to do. And then we come back on Tuesday, the 17th, which will be August.
I'll still be on vacation, but I'll definitely be there for that episode.
Yeah, well, we're gonna, you know, we'll tune in. We'll have to check that Wi-Fi, because, you know, if we need to adjust that time, you know, we'll figure it out.
If worst comes to worst, it's like, you know, I got some, you know, some backup. You know, the run-up cousins are here for it.
Totally. We have, speaking of run-up cousins, so on the 29th, we're going to do something a little fun, and play a massive game with some of your favorite cousins. Those particular cousins are yet to be confirmed, but once they are confirmed, we are going to play some games and have some fun, especially as it's our last show before vacation. So expect all of the stock market shenanigans, all of the sector rotation shenanigans, expect it all, because it's going to be a party and a fun time.
And I think that we're supposed to be receiving a new SIPs list coming soon. So
nice.
Yeah.
So get ready, y'all. We always say subject to change, so get ready for that. It's 6:57, so
I guess I can give some like little tips here in moving forward, because some folks are definitely like, hey, Mark, well, what should we be expecting, to condense it down? All right, let's start the timer. I got 2 minutes. So something that's to take into consideration as we move forward this week, all eyes are definitely on Intel. If you see Intel drop, then definitely keep your eyes on AMD, because that could be a huge sign. And Wall Street is actually starting to lose faith in Intel because of the fact that we hear a lot of PR hype train. So essentially you can see some moves there. Of course, next week is going to be a massive week. I mean, it's going to be pretty much the heavy hitters of, say, for example, tech coming through. You're going to have players from Tesla, Apple, AMD, and many other players. We're probably going to see like 5 chips report earnings within that time frame. So definitely keep your eyes open there. The name of the game is really not going to be in the sense of the earnings, but more so in the sense of the guidance. Investors want to know, hey, has the narrative changed? Has the sentiment changed? If that is the case, then we're going to have to go back and readjust our thesis. So that's really going to be what everybody's paying attention to. We've already seen a lot of companies just literally blowing the water out of their earnings by over 20%. So I think that Wall Street is kind of like priced it in, saying, hey, we expect some strong upside for a lot of these companies. But at the same token, keep in mind, you may want to potentially, just as a heads up, it's okay to hedge around this time of year, to just set it for, say, for example, October, just to hedge against your portfolio, especially within the long term, just from any potential downside risk. You could be even using that as, say, for example, a put against the SPY, which is the S&P 500, or even against your own positions, whatever you may have, or just take money off of the table and pretty much just go straight cash. There's nothing wrong with that. But that's something to keep in mind, especially when it comes to a lot of the earnings and a lot of the earnings guidance in which that we're going to hear for the quarters to come, especially coming out of the tech side of things and consumer discretionary. Is the sum of all fears over and done, or are we still preparing to see some of those early pains ahead? And on top of that, how does COVID-19, especially as it pertains to new variants, how does that play a role towards a lot of these company strategies? So I would definitely pay attention there. So I'll leave it there.
Right on the dot. It's 7 o'clock. Chipotle is on the way. 15 minutes till they show up.
Oh, okay. Well, y'all, thank you so much for rocking with us. Jolynn, thank you so much for just allowing me to grace the stage as usual. But we will see you on Thursday. keep studying, keep researching, keep watching the markets, keep watching the economics. And on top of that, just keep being you, which is your awesome self, and just be kind to others. Until next time, I'm Mark Monroe.
And I'm jolyngc, about to eat this Chipotle. I had to say it like that, y'all, so it could rhyme, but Chipotle, you know.
And this has been your come up on Trade Talk Tuesday. We will see you on Thursday for some hot takes.